Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and let's start building your wealth.
My background is I'm a CPA. I've been doing this over 20 years. Our client base is entrepreneurs, so I invest in lots of different things. I joke that I knew about cost segregation before it was cool, but really our goal is to educate individuals looking to better understand their tax picture as well as tax strategies to obviously you know deploy that capital somewhere else other than taxes every year. So what I wanted to do was sort of walk through some scenarios that may help to understand, because what we've seen, and as we've gotten more involved, and especially on the short-term rentals, is a lack of kind of understanding of why is this different, how could I use this to change my tax picture, and how do I really grow wealth through rental properties, especially short-term rentals. So what I prepared is sort of like a one-pager as a starting point to just kind of walk through and ask questions, rather than it just being a typical tax lecture. Like, really leave this more informative, because like I said before, my biggest belief is that every situation is different. So everybody on this call, there may be some common ground, some similarities, but ultimately there's definitely things that make your tax picture unique to you. And so really what we want to do is start with building this for you and not just everybody across the board. But that being said, what we started with was sort of a one pager, and I'm happy to share this with everybody as they go. But really the idea is we believe that there's a three-phase approach. So the first is understanding your effective tax rate. Some of you may have done this, some of you may not, because your taxes are all made up of several different tax rates, different income sources, different time in life, deductions, all of that. But what we want to do is put that all together into one effective tax rate. And by understanding that, then our first phase is to sort of say, could there be areas where I could redirect that? Could there be things I could do throughout the year? Obviously, completely legal, but then ultimately get to a better result while also making it a solid investment. I think where we start with, especially in recent years, is that traditional W-2 income earner. That what you've seen is that as some of the itemized deductions went away and we have a more standard deduction for everybody and less people itemizing, that effective rate for that W-2 wage earner has gone up over the last 5 to 10 years. And where that's felt is just that person feels like they're paying more in tax, and there's very little that they can do in the current code because of less itemized deductions and the medical expenses and the SALT, state income tax going away, that where there used to be some strategies you could deploy, there's not as many currently. So at the same time as that was happening, this whole world of short-term rentals came into play. And I think where it's very important to first understand that fundamentally from a tax perspective, the short-term rental is different than a long-term rental. That the short-term rental, every situation is different, but in theory, the short-term rental could be considered ordinary income or ordinary loss based on several criteria. And what that means is if you're that same W-2 income earner where you feel like you're paying more and there's less you can do by entering into a short-term rental, potentially, and again, every situation is different, you could offset your ordinary income with this short-term rental. At the same time as that has happening, and short-term rentals came into play a lot during COVID, this whole idea of people being able to work from wherever because of technology. At the same time as that was happening, we had the depreciation increase, right? So all of a sudden we had this 100% bonus depreciation. We had the idea of, cost segregation or cost allocation. And so what it really did was sort of create the perfect storm of a new place for tax strategy to live. And so while it's not for everybody, and I'm not an investment advisor, I think it's important for people to understand some of these fundamentals, because there's so much out there that just is either wrong, doesn't make sense, or just sort of glosses over some of these very important fundamental differences between short-term rentals and the rest of the rental world. And I would tell you from an accounting or tax standpoint, historically rentals got a very little attention, right? It was sort of one of these things where it was break even at best. It had, some depreciation, maybe there was some positive cash flow, but there really wasn't a lot there. And one of the things that I have seen become so nuanced is the idea of it becoming ordinary income, or you potentially qualifying under the tax professional, which is or real estate professional, which is something much more broad than just being a broker who sells real estate. And a lot of tax professionals just aren't even aware of these changes because they're so new and came at a time where our industry has gone through a lot in the last 5 years with COVID. So, if they don't know, don't blame them, because it's been sort of, crazy whirlwind. But that being said, you as a taxpayer, you're the one that really should know these things and just make sure that first you're falling in the right bucket. And second, that there is, sort of a plan or a strategy behind it. So that being said, I think the idea of our first phase, which is redirecting, would just be to take a look at what would happen if I focused my attention on some of these other asset classes, right? Not just markets, or not just, 401ks or pre-tax accounts, but what if I actually diversified into some tangible real estate assets? And I think that's where, whether it's short-term or long-term, the first understanding is this sort of Schedule E or rental property, and what are the differences. I think the other thing that we've seen in recent years as the tax code has changed is the idea of the mortgage interest, right? If you have a personal property, you may not be getting all of the mortgage interest, but on the rental side, you do. So there's a lot of differences in recent years. So first idea would be that, focus on assets and just look at our tax picture as a whole. The second phase of it is the idea of the reinvestment. And I think this is important because, again, historically, from a tax perspective, CPA historically would sort of always advise that maybe bonus depreciation or accelerated depreciation is a bad idea, right? Because it's going to set me up for more taxable gain potentially. I'm going to have less basis in the property, and that could lead to a bad result. I think when you're looking at this as an investment, every situation is different. And I've definitely had cases with clients who have said, it makes sense not to take the bonus because the property is going to be profitable every year, or your income is going to change, or for whatever reason. But I think as you, the investor, it's good to just play with those scenarios of what are the depreciation options, what would happen if I took bonus depreciation. Is my depreciation being calculated correctly? Because as a short-term rental, it's actually a 39-year useful life, where a residential rental is usually 27 and a half years. So just to make sure that that's all correct. But the idea of reinvestment potentially would be that we strategically take more depreciation up front so that you can reinvest those dollars into another property and sort of play the game of having them stack on top of each other to a much bigger portfolio down the road. Now that comes with some hurdles that could potentially have taxable gain, but that's where I think ultimately building the structure for you, the investor, rather than everybody's the same, I think that's where you get to the best result, because that could be a scenario or it could not be. But if we're not having those conversations before we file the return, then we sort of miss the boat on a potential for being able to reinvest that capital. And then, the third one is the idea of that ultimately in any rental, I think what also gets missed is we look short term. I've had this all the time, especially this year where the short term market has softened a little bit, where it's like, well, I'm not cash flow positive, so I should sell. Well, I think what we also want to do is sort of really understand the asset appreciation that happens in real estate, because I think a lot of times we forget about that or sort of look more short term and forget that if the properties break even today, even if I just hold it for 10 years at break even, I'm still appreciating because of the inflation, right? That it's hedged to inflation. I'm potentially paying down that note. So what does that appreciation look like for this investment? And I think if we can look longer term, build out, a lot of our clients, we build out what we call a rent roll, just to see over time, what does that appreciation look like? Then ultimately, I think we have a really good understanding of the investment piece, as well as the long-term tax strategy for this investment and for you as a whole. So with that as a starting point, do you have anything or any direction that you want us to go?
Well, what I like to do is for all the agents here, you guys, make sure you take some notes and share this with your clients, your investor clients, because remember, this is the kind of stuff that helps you stand apart from other agents who aren't thinking about these things. They're just thinking about the next transaction. So if you focus on the relationship and help provide valuable information and services like this to your clients, that's what sets you apart and gets you repeat business and referral business, particularly from investors. Okay. I mean, Kendra, I was on a call with Kendra today, and she's got one client she's had 6 transactions with, an investor. Okay. That guy could clearly use this information. So keep that on. If you have examples of some of your clients you want to bring up, you've got Ann right here, right now, live. So I would definitely, ask questions, bring up some scenarios. Um, so we could, if you want in, um, maybe look into like number 2, reinvest, or any one of these categories, start there. And if you have like a case study,
Yes, so I do. I
or
have a couple of examples. I just wanted to make sure there
okay,
were no
all right, cool.
questions. So I think the first example I'll walk through is the idea of the potential, again, potential tax savings of somebody who invests in a short term. So hang on one second. Let me just switch my screen. But this would be because I think sometimes people lose sight of the true dollars that that are on the example, or of what this looks like. So okay, so and again, this is not for everyone, so I just advise this is not necessarily common, but I think it's important to really understand what we're talking about when we talk about the impact of potentially it being ordinary income. And I've seen this a lot. If anyone has questions for this, or investors have questions for this, I can send you. I have like a great one pager, a few of them. But recently we dealt with one of our clients, and his previous CPA had disregarded a couple of his K1s from real estate investments because they said, well, you're not, technically a real estate professional. But in the IRS rules, and it's pulled right from the IRS, that actually is a more holistic view that yes, in this activity, he was not active, but as a whole, he is, because at the same time as he was investing in this passive activity, or more passive, he also was flipping a house. So if you read the wording, and I had him read it because I always believe that you, the taxpayer, need to know if this fits you, that then it really did say that, yes, that does fit what I'm doing. And I'm comfortable saying that I should be, or again, not for everybody, but in his situation, based on the 4 criteria the IRS gives, he ended up being at, more of an ordinary income, which then was able to offset his W-2. So in this example, that's what we're really looking at, that if you had a typical taxpayer, higher income earner, who's just paying W-2s in 2023, they basically would have paid about $84,000 in tax. So significant tax dollars. But in this situation, again, if they were to invest in a short-term rental, probably a larger property, newer property, in this example, it was new construction. They also put a lot of money, a lot of these STRs, as a separate conversation, it's become a lot more of a business, right? So they have design teams, and they have, all of these consultants that are coming in and helping them, put the coffee maker in the right spot and all of this stuff. So it's a significant amount of capital to get, a really well-performing STR up and running. But that being said, for this tax year, I mean, they were able to save up to 70,000 in real dollars. And that's where that whole idea of reaccelerate comes in, of yes, there's some risk. Obviously, we would want to go the longer term, which I will show you on the next example. But strategically, it makes more sense to get the capital back now, even though my basis is lower in the property and I could have a potential gain in the future. But knowing that, I'm going to build my strategy to where if I exit this property, whether 1031 exchange or whatever it is, I'm comfortable with that because I would like my dollars back sooner rather than later. And I think from an IRS standpoint, depreciation is one of those things that's just a pie, right? If I take it now, I always want to make sure my clients very well understand that it's not there next year, right? This is not every year I'm going to save 70,000, but this year I am. And now strategically, I'm going to be able to reinvest that into another property potentially. So I think, especially if you're a real estate professional, kind of understanding that sometimes they're just looking at the cash flow of the property. How much is it going to, generate in operating income every year? And sometimes they forget the tax piece, which could also be, beneficial at the beginning, because at least I'm getting 70,000 of the money that I put up front sooner rather than later. So any questions so far or no?
Yeah, so far so good. I think Kay was asking if you could share your slides too. Some teachers will, some teachers won't.
No, I'll send you both our one pager.
Okay.
I'll send you, just our templates, because again, this
Mhm.
isn't for everybody, but I think kind of understanding, at least it gets them to ask the right questions to their preparers. Because what I've seen happen far too often is they're, as the investor, they're so involved with these consultants and the people doing the cost segregation and all of that. And then they turn around to their tax professional and the guy's like, you don't qualify. So, because in typical, without this being categorized as ordinary income, they would not qualify to take most of the loss in this year, that it would be a minimal amount of loss that they're allowed to have this year, and the rest would just get carried forward to the future, which again, not lost, right? But it wouldn't have the same dollar savings depending on the classification. And the dollars can be exactly the same. I saw with my one gentleman with the K1, it's just what box was checked. And so his CPA had not checked the box. And so it's just sitting there in a carry forward and not benefiting him in that current year. So I think it requires more of a conversation with the preparer and not just, I'm going to hand over everything. Oh, I gave him everything. Why don't I have a refund? So, you just want to make sure they're asking the right questions.
Well, the carry forward, what are have the rules changed on that? Do you know? I haven't done that for a while.
Yeah,
But I
you
did have.
still can carry forward, I think it's 20 years, but if you sell the property, you would get it in that last year. So it's not
Okay.
lost. So, if you exited next year, even in this same situation, it would just go against, any of the gain on the sale. So it truly is a pie. And that's where, I think them first understanding that you're not creating additional money. It's more about the timing of what year are you taking,
Yeah.
the loss.
And you could do it, you could carry forward up to 20 years, I think you said, is that?
Yes.
Okay.
But again, if you exit the property sooner,
Right.
you would have that there. And, I think the other big thing that I've seen is a lot of times in rentals, again, because rentals were sort of not paid attention to as much as some other aspects of returns, that the CPA may have just made this decision for them. Might have just said, you don't qualify, you're done. And it's just been sitting out there. So if that is the case, there is actually a form with the IRS that you can go actually retroactively correct it in a current year, depending on the situation and depending on if it was an error or, just put in incorrectly. Because a lot of times, even in terms of the rental, if it's a short term or a long term, the useful life is wrong. I mean, depreciation has some, I've seen lots of mistakes in this area. And really, it all stems from just not having that conversation with the preparer, that it's just prepared and then sort of signed off on, and no one's really paying attention. So I think it's good to know whether you're, dealing with investors, just to say, it doesn't hurt to take a second look and just make sure that you're in agreement with how things have been put in the returns for prior years, as a good starting point. So this is the starting point. It's just kind of looking at, and I think this is true for any investor. I think it's important for them, if you're a real estate provider, you're, showing them properties, to just say, like, have you looked at how this impacts your tax return before you pull the trigger? Because it can matter. The other thing that can really matter here is state, right? If you have someone who lives in New York, but they bought the property in Florida, right? Like, that could be different than if the property is in New York, potentially, right? Depending on what else they have going on or what they're paying in the states. The other thing to really be aware of is most states don't recognize bonus depreciation. So even though you're saving a lot of money on the federal return, you may still be paying in at the state level, and there's not that much we can do with that. So just looking before we make decisions is always the best thing to do. So this is our first step in that Recelerate, is just to say, okay, let's plan out, would it make sense to get 70,000 out, or would it make more sense to strategically be more break even and look at saving that against future income. So that's where our next phase, which is looking at a longer term projection for the property, really comes into play. So I will share that example next. So hang on
Okay.
a second.
Hey, by the way, on the so the time frame is 20 years, or if or until you exit the property, but is there a dollar amount limit in there too? Like you can only um carry forward so much. I don't know if I'm making sense, but I don't know if there's restrictions on that as far as how much you can carry forward as far as
Yes, so
okay,
it depends largely on income. So if
okay.
we go back to the strategy, and actually I can send as a follow-up the new wording because that has got so far, who knows if things change, but has gone down even further. But if you're above a certain income level, you're capped at either 25,000 loss or in some cases not at all, depending on income level. So again, it could be the case that if the CPA is not paying attention, even with the same dollars into the property, they actually get nothing or very little because of just income level. So, so it's not only the dollars; it's really just also those income categories and their level of participation in the property. So, what I'll also do as a follow up is just send those 4 criteria because it's interesting to read through because the IRS, like I said, the IRS wording for real estate professional is just different than most of you guys. So if your client says, well, of course I'm not a real estate professional because I have a day job, that may not always be the case depending on these four criteria. So you just want to make sure that they understand what that difference is and ultimately what that would change on their tax picture as well. So okay, so the next thing that I like to do when looking at the property. So, let's say we said, well, I'm not sure if I should take a $200,000 loss because I might be, really hurting myself in 2026. So what we always recommend is we want to really look at our projections for this property and make sure,
Mhm.
do we know how profitable it's going to be in future years? Because again, every situation is different, every property is different. So some of you may have seen this being, real estate people, but starting with your traditional rent roll where we're going to look at, our rental revenue. But I think the key here in any projection, and I find so often new investors, people you're showing properties to, they don't think about inflation, right? I'm not saying you're going to make more rent because you're going to do anything different in 5 years. I'm just saying that just inflation alone, your rent will go up. So we just want to get them to think about that it's not like the pizza place down the street where like you have to sell more or go advertise or whatever. Like in this world, you're tied to inflation whether you like it or not. So we want to build that into our projections because as we've seen in recent years, there's years where inflation can be, much higher and there's years it can be lower. So just as a starting point, I like to just kind of have some inflation in and just show them that, over time it's probably going to appreciate a little bit. We don't want to go crazy there. The other thing that
Mhm.
I think is really important for investors, and I've seen this a lot in recent months with SCR. I don't know if you guys have seen it, but softened a little bit, right? Not quite as crazy good as it was in the years past. So a lot of times people will say, well, my property's not cash flow positive. Well, I think it's important that they separate the money that's going towards the mortgage and the interest from the principal and the interest from the operating costs, right? Because you
Mhm.
would be contributing to a 401k, right? You'd be putting money into some investment. So the money that's going to pay down that principal, I mean, that's really you on more of a financial decision than operationally, right?
Mhm.
But the property we want to see as what is it doing before I talk about, how I paid for it and all of that. So here what we do is break out our operating expenses from those in, that financial piece, which is how we afforded it. Because again, especially in recent years or future years, interest rates may go down. So we may be able to refinance this loan. We may have cash from other places that we pay down the loan. So we want to look at these two pieces separately. So in this example, obviously we look at our projected net income, our projected cash flow, and then we would want to tie in our loan interest and our loan principal. So when I do this with our clients, I also grab the amortization table because I think they also don't realize that as you hold it more years, you pay more down in principal. So even if you have a property that's break even, it always kills me when they want to sell because they're break even, because you're paying down your principal, right? Like you have an asset that is growing, even with it being break even today. And once we factor in inflation, it's probably going to be profitable in 2 or 3 years. So we don't really need to go sell and buy another property right now. We may just have a longer term appreciating asset. So I think that's really important for them to see that. And so I typically grab the principal, we grab the interest just from an amortization table. And then I think, the third part is factoring in that initial depreciation from a tax perspective. So based on what we did on the property side, that initial loss, if I know I'm accelerating my depreciation, let's go ahead and put that into our model so we can see, okay, look, year one, I'm really saving, 10 grand in taxes, but then I still have some residual depreciation that I'm going to have every year just from where we are in that bonus rule of 60-40, plus there's some that's just for the building. So over time, my depreciation may go down, but ultimately my tax savings, at least for the few years, I can see. And then finally, which I think is where, you guys as real estate should really remind them that even as the market ebbs and flows, this is an appreciating asset because it is tied to inflation, right? Over a 10-year period, it will go up. It might not go up today, but it will go up. So we want to factor that into our model because every year you are gaining this equity into this property. So we don't need to panic on a bad year because look at our equity grow over a 5 to 10-year period. And all of a sudden, this is where our real wealth comes from. So this model, I think, is the most eye-opening, but so few never do it. But I think it really could change the course of deciding on, exiting too quickly or even, what mortgage to go into, just because I think you have to see all of the pieces together to really make your decision on if it's a good investment.
Okay.
Any questions so far?
Yeah, I'm actually looking at, I'm a numbers guy, so I'm actually
I
looking at
noticed, Dan, that you use 2% as your rate of inflation, where I've often seen 3% being used on an annual basis.
I mean, I've tried to be very conservative this year because it does feel like it's been so crazy in recent years. But I agree. I mean, I think 3% is probably, good, but I try to be very conservative on the.
I just wonder what your rule of thumb is because, in figuring these out and when you do show these to your clients, do you use like 2%?
I have been this year just because of more on the property value appreciation side. I mean, I think you could potentially use 2 or 3, but we deal a lot with the short-term rentals and they have seen less appreciation in 24 than they have in prior years. So because of that, most of the models I've built this year, I did scale back to 2%.
Oh, okay. So just short-term rentals, not regular rentals.
I mean, I think across the board, it just seems like, I think the inflation was so crazy, but I've done models of like the last 5 years. It was so much that you would think that there would be a couple of years where it is a little less. But again, I try to tell them that we can do this on several different, right? Because it also depends on area specific. You could be an area where it's growth and there's things that are great. So I think it very much comes down to what they're comfortable with. But I agree. I think between 2 and 3% is probably very fair.
Okay, just curious.
Yeah.
Hi, I just want to take a moment to thank you for watching a recording of the Monday Night Live class. Hope you're getting a lot out of it. I'm sure you will. I wanted to let you know that, you can come to Monday Night Live whenever you want, but you can also participate more with the team. Why don't you set up a call with me, a one-on-one strategy call? I can go over everything with you, show you everything that we have to offer. For example, did you know that on our team, not only do you get your leads, we actually give you your own account on our lead gen system. So this puts you in control. You're not waiting on somebody to hand you leads. You get to pick the ones you want. Okay.
Huge difference. We have 21 of our own proprietary marketing campaigns. They're all copyright protected. We're the only ones that can use them, okay? The coaching is absolutely one-on-one. We got 3 coaches. We even have a 4th success coach that we have access to, okay? One of left fewer than 100 in the world, okay? One-on-one coaching. Right now the big problem is volume. We need more transactions. We need more inventory. I get it. Well, we know how to get it. Our team actually outproduces the national average by more than 2 to 1. So if you're struggling, don't do that anymore. If you're a solo agent, if you're a team, let's just talk. Smart entrepreneurs are always open to discussion. Learn what we have to offer, and then you can make an informed decision about staying where you are or moving on. You've got to decide, if you're not where you want to be, you've got to take action to get where you want to be. Let's see how we can help you do that. I look forward to talking to you. Click on the link, set up a call. And by the way, I'll see you on the next Monday Night Live.
Right. Well, I think, as a next step, I think the key would just be, again, taking a step back, going back to believing that there's 3 phases, right? This really is the 3rd phase. And what I've told a lot of our, multi-unit owners is you really want to do this for each of your investments and really ultimately go back to what is a great exercise for what I truly believe for a lot of our, rental clients is once a year, I walk through with them filling out the personal financial statement, which you need for a bank anyway. So it's, saving us all time, but it's eye-opening to see that appreciation put into motion that when you really start to see, I'm sure a lot of you are familiar with that page, but the first page of the personal financial statement ends with your net worth. Right. So every year, as your appreciation grows and that debt is paid down, your net worth is truly growing. And I think that's where you can have another aha moment. I have a client who has 4 rental properties and just another business. And we did that at the end of the year. And it was like, oh, I finally understand why I invest in real estate. Because up until that moment, he was annoyed because he's like, I feel like I'm always replacing the AC and I had to put $5,000 in. And then all of a sudden, when you see his net worth is, like over 2 million now, and it was probably like $1 million 10 years ago, he's like, I don't mind the AC. Like, I think I'm good, And I think sometimes just that's a great other reminder of, really what we're trying to do through real estate is just that, true wealth appreciation.
Mm-hmm. Yep. Yeah. At the end of the day, when you add it all up, really, a real estate portfolio, at least this is my experience, and a lot of other investors I know too, they really, you structure it so that you don't actually show a lot of cash flow because you got to pay taxes on that. So over time, what it's doing is it's building up value, and eventually you got enough value there collectively that you can borrow against that, leverage against that to create, like be your own bank, buy the next property. And so now this portfolio of yours is acting like it's just building itself. And that's what you want to get to. And over time, you can always leverage and borrow more money out to do more investing, or eventually you just want to cash in, you start selling, but the key is to get it to where it feeds itself, and the more you do that, the more tax benefits you have. Things like depreciation, and there's other things too. And I don't know if this is appropriate or not. I had my properties in LLCs, um, and we were able to use, I think it was tax rule 172. It wasn't 179. It was like a business that had a big capital expenditure, a capital outlay. You could expense it in the year you took it. They let you do that, like, I don't know, one time or something. And so if we had a major, like a roof job or replacing, one time we replaced 6 boilers, it was $200,000. The tax accountant said, this is a business, it's an LLC. You guys can take the entire hit in 1 year. You can expense the boiler job in 1 year. Is that still allowable, or is that, am I,
Yes. So I think the rules, they've kind of changed the wording somewhat, but yes. And I think the thought is that, right now we're sort of in a 60-40 split on most of, depreciation rules or capital expense rules. There's several different ways to get there. There's your bonus and there's your traditional 179. But I think the thought is that they may bring that back next year to back to 100%, or at least back to 80%. So I definitely think, but I think you bring up an interesting point. I think, setting these up as LLCs, there is also out there the idea of the asset protection side. And so I think, the best case scenario is that those two conversations happen, both the tax side and the asset protection side, and just make sure that, one side understands the other. Cause I have seen a lot of cases where people have like gotten into these multi-member LLCs and then roll up to other LLCs and, can really just kind of mess up the tax side if the tax person isn't aware of those changes. So I think as you're talking to clients about asset protection and things like that, it's very important, but you just want to make sure that you also kind of still understand the tax flow, because there's just a lot of, confusion on that. But, overall, I think it is, it's definitely something for them to think about, the LLC factor. That also can help in this, world of ordinary income, because it is treated as a business. Another thing is, even something as easy as sending out 1099s can be one of the justifications to show that you're a real business. So it sounds silly, but just reminding them, hey, if you are looking to, claim this as against ordinary income, 1099 your cleaning person. That's the easy way to just show the IRS that you really are treating this as a business.
So, Anne, that leads me to a question, because I've used that lump sum deduction because of a business, like that Gary is talking about. But is it the same? And that was, for an LLC. Does it work the same if it's also in a trust? Or does it have to be an LLC?
I can double check. I don't know that the trusts qualify. There's so many different types of trusts.
No, I know, but I'm just thinking, if you've set up everything, through your trust, and, instead of the LLC for asset protection purposes.
Well, so if it's a revocable trust and it's still just living on your individual return as a Schedule E, there'd be no change to your tax. That the revocable trusts are just, they're sort of disregarded from a tax standpoint in most cases, that they just are on your individual return, even though asset protection wise, they are in that revocable.
So there could be some advantages for putting an LLC and then sending it through your trust.
Potentially, yes. I think the other case is your LLC could be owned by the trust, and then that also.
That's what I mean.
The LLC
That's what I mean.
side.
Yeah. So
yeah.
There could be some advantages for having everything layered.
Yes.
Yep.
Yes. Yeah. Okay. No, that's a really
Thanks.
good point. And I think that's the other part of kind of understanding some of the functionality is I think a lot of times people, sorry, I'm frozen. You see me? They don't realize that what the LLC can do, and sometimes they shy away from it, but it really is a good vehicle.
There's a lot they can't do too.
Well, that's true. But I think just understanding it, and understanding the differences, like you said, between the trust and the LLC, and, just to look at both sides. So I guess, are there any other kind of just generic tax questions as we get into, the last few weeks of the year? Anything else on top of mind from the real estate side of things?
One of the things that everybody's curious about is going forward, like with the IRS, we just, obviously there was a, the recent news in the last 2 years is the IRS is going to be adding 87,000 more people, and they're not all agents. There are a lot of administrative roles and things like that. How is that changing? I mean, I personally, I think there's obviously going to be more audits, we had somebody on the other week, and we already kind of knew this, but during the pandemic years, there was the activity level in the IRS was dropped down dramatically. There was already a lot going on in the country, and I think the reason why they brought in 87,000 new people is they got to play catch up. I mean, that's real money that goes into the U.S. Treasury's coffers that has to pay for stuff. I mean, all that stuff we did in the pandemic, that's not free. The PPP program, the employee retention program. I mean, it just goes on. Now there's something else, I think, called SETC. I forget what it stands for. It's a tax credit, but it's for small business owners that were impacted by the pandemic. Like you had to be quarantined, or you had to care for someone in your family that had the virus, and they're giving people a tax credit for that. Have you heard of that? Or I don't, other than seeing it on promoted. I know it looks like it's new, but it expires next year. So they're telling everybody, you got to get on the ball here and get your application.
I mean, I think there's a few variations of the employee retention tax credit, but some allowed for like individual sole proprietors to also get it. So yes, I think, there's definitely some lingering COVID things that, but I think across the board, I mean, I think, as a profession, the accountants, CPAs, it was a rough go. I mean, I'm sure it was a rough go for everyone. So that's not, feeling sorry for us, but I think that it was a very rough go just because of all the uncertainty and all the rule changes, which had to happen because, the government had to help people in need. But, it really did wreak havoc on the softwares. I mean, I had a year where our software just had glitches and, then the IRS, you couldn't get a hold of them. But what we've seen, sort of behind the lines is that, they did close. I'm not many people are aware, but they did close for like a 5-week period last year at the end of the year. And it really has been much better this year. So I do think that they're sort of working through a lot of those lingering issues and, really trying to kind of get ahead of it. I think the software obviously helps, technology. But I think what you really see is that, they're just trying to get a clean start. So I would say if you're ever talking to any of your investor clients or people are unsure, they actually have a great way where you can request your own transcript and just make sure that like your records match the IRS, that they have, everything's in place. And, I think that's the best way before we move on to the next tax year to just make sure everything's in one place. Cause it's been a mess, but I feel like it's getting better. And I think, regardless of anything, I think, with November behind us, I do think, it seems like people are just ready to kind of move forward from the COVID years, and a lot of that stuff expires next year. So I think it should just be a lot clearer than it's been.
Is there anything tax code wide you're aware that's like coming up? It was put in place, but it's gonna begin in 2025, or anything that's going to expire that we have had? Like please forgive me because I don't really watch the TV much, and I get what I get from just turning the computer on and research. I'll go to the Treasury Department website, or I'll go to the Congressional Record and get the actual stuff there. But I know there's talk of certain things expiring, but now that who knows? I mean,
no, I think there's a lot, and that's what I think what you've seen, and I think a reminder to some of these investors is that even if they have someone who's a little more understanding of business side in office, that a lot of these tax codes are set to expire anyway. So if they don't really change course, the qualified business deduction, which is a huge deduction for most small business owners, it basically reduces them to an effective rate of 25% rather than it being tied to their ordinary income rate, which could be in the low 30s or mid 30s or even high 30s. So I have some clients where that qualified business deduction saves them 6-7%, just on their business income. So if that goes away, those are real dollars that they will be paying that really has nothing to do with business performance. It's truly just the way their tax is currently being calculated on the return. And that expires in 25. So I think the idea of diversification, the idea of the reinvesting and sort of building out your own portfolio, I think regardless of who's in office, like you said, we're going to have to pay for a lot of these things and taxes will go up. So I think it's, important to remind people not to get complacent and just think, oh, everything's going to be great. And, taxes aren't going to go up, because I think regardless, they are going to have to continue to go up. And I think that's the one thing too, when we look at, sort of that longer term view, I would also say that, I've been doing this a long time, and my happiest retired clients are clients that have a real estate portfolio. So I think when you're walking with some of these, especially younger investors, it's good to remind them that, 15, 20 years, it'll come and go. And, when these properties are paid off, this is basically like you creating your own pension, right? Like you now have the income that you control, that doesn't have crazy fees, market fluctuation. And I can tell you, as great as it may be to invest in the market, and I see both sides, those guys are stressed in retirement because, all of a sudden there's a market crash and their dollars go away. Where at least in real estate, the clients that I've seen, and I've seen this for 20 years, are just in more control of their own destiny. It's not that real estate doesn't go down, but they just feel more in control than the market. And not that you can't have both, but I think it's something important to remind investors of that peace of mind you can create through this type of investment.
Yeah. Well, the thing is, to me, it's the next best thing to gold. It's actually, I think, better than gold because not only does it generally hold its value over time. I mean, the last recession, values went down, but they came right back up, and they just
Right.
far blew away everybody this last 4 years. But it also throws off income. So you've got an appreciating asset, a physical, tangible asset that actually generates cash flow and some tremendous tax benefits too. Because rental income, you only pay income tax on that. It's passive income. You don't pay FICA. You don't
Right.
pay Social Security. So it's a less taxed asset anyways. And at the end of the day, now there's products out there, guys, and this was really blowing me away. There's now annuity products out there where you can annuitize a piece of real estate. If you've owned it, like Ann said, if you've owned it 20, 30 years, it's paid off, you can annuitize it. I mean, that means you get the payments for the end of your life guaranteed with no headaches. I mean, it doesn't get any better. So stay tuned to that. This is all relatively new. I'm learning more about it myself, and I'll have the person come on and speak about that when they're ready. So, but it just never. That's why I always tell myself, just relax. Don't ever panic. Just prepare
Yeah.
because things will change, the market will change, the laws will change. But at the end of the day, entrepreneurs always find a way. We do. And there's always something out there for because if we don't have businesses creating jobs, the economy's going to die. You need somebody generating business to employ people that pay income tax, right? So and there's enough smart people in Washington, I think, realize that in spite of what we might think, based on what you're seeing on the news, I think there are enough level-headed, common sense people to make sure you let business continue to be business because otherwise you end up, who knows what you end up like. I could name some countries, but I don't want to do that. But the point is that's what makes America great. It's a huge pain in the butt, but it's there. The code is your friend. The code is use the IRS code like it's your teammate. You know, the problem with people paying too much taxes is they probably don't use the tax code. You know, so anyway, sorry, that's my soapbox moment for tonight.
No, and I would just piggyback on that of like, I think it's less scary than you think. So, even just encouraging, your clients or, people investing that, it's really good just to take that look at understanding how you're taxed because it really can change your decision making on some of these investments. And I would also say, I think, for some of your more savvy investors, there's lots they can do with those pre-tax accounts. There's potential of reinvesting those. But I think all of that stems from just knowing your effective tax rate. But, I've had clients who've done like Roth conversions or kind of moved over from a 401k to an IRA, and all of that is great. But it's only great if you know what you're taxed currently, because otherwise you're just listening to someone tell you to do it. You're paying a lot to the government if you're doing a conversion or anything like that. But it all starts with knowing your effective rate. And it's not hard to do. So I think if, taking away the fear, just, the tax return looks horrible. It's not fun to look at. But if we can just get to your taxable income, over your tax over taxable income, and then we have your effective rate. And that's a great place to start because on the flip side, I've seen people panic and say, I have to buy something till the end of the year, but you're in like a 10% rate this year. And maybe next year you're going to be in a 15% rate. So if we know that rate, then we can make, the best decision possible for where you are today.
Yeah. Hey guys, I want to add one more thing here. So if you think about the guest teachers I've had on recently, right? That Carlos last week about dealing with what happens, if you haven't paid your taxes, you haven't filed, if there's an audit, how do you deal with that? And then before that, cost segregation, right? So the reason we're doing this, it's like a series, is because of where we are in the year. We're at the end of the year. So your clients are out there right now thinking already about next year. Could they buy another property? Should they sell a property? They're trying to position themselves for the most favorable tax position. So you can share these recordings with your clients. Say, look, we just learned about this Monday night. Here's the latest thing that we learned from Ann Gannon. So keep in mind, this isn't all just because it's educational entertainment, which it is. It's to be used for you guys to use in your businesses. That's what this is all about. So if I hadn't say that explicitly before, bear in mind that this is all meant for you to share and help you, earn client trust and grow your businesses. Does that make sense, guys? Like how you can use this? Yeah, the podcast, you know, otherwise I'd be fishing all day, but I don't want to do that. I get bored too easily. I like doing this stuff. It's a lot more fun.
Exactly. And as a follow-up, I will put this all together in sort of a couple PDFs, just so you guys can see, how those 3 phases work and the tools that we recommend for each of those phases. Because again, I think the best way to do it is have the investor do it themselves. I mean, I'm happy to build them out in Excel, but the key is that they own it and they understand it. And I think, the goal is that these are simple enough to where they should be able to at least get started and start to have some of those aha moments of, oh, well, I'm doing better than I think.
I think Kurt, do you have a question, Kurt?
Yeah, I had a question. This is a pretty timely. I'm going to meet with my tax preparer like on Wednesday here. And how do we know that we have a tax preparer that really knows what they're doing? Because I listen to you and there's a lot of stuff I'm hearing here right now that we never talk about, so I know it's all very individualized on what your goal is, but yet at the same time, I don't even know the questions to ask really that you're kind of pointing out here tonight. Is there maybe a list of things that can kind of test that CPA or the tax preparer on, understanding some of the things that you talked about tonight?
So I would definitely say, a great place to start would just be to walk through your rental properties on your return. And just make sure that those match, what you have. So I'm assuming you have rental properties, but, either way, that's the best place to start. Because, anyone could look at a return and say it's right or it's wrong. But I do think, just making sure that that bottom line makes sense to what you have. A lot of times there should be a detailed depreciation schedule just to make sure that those assets, match what you have. And ultimately that the picture they're painting is the one that, you're seeing on your end. And then from there, a lot of times you can see, okay, so the one example of the guy, it's like, well, why does it say 0 next to this investment? I know it wasn't 0. What happened? And then you can start to have the conversation of, here's why that loss was disallowed, or here that it is a carry forward. And then from there, you can feel more comfortable. But I think, so many times on those Schedule E's, each property tells the story, but sometimes it's just so easy for things to get missed. Because the other thing that people don't realize in the rental is it doesn't report a balance sheet. So if you bought an asset, I mean, so many times you did a remodel, it is easy for that to get missed because the IRS only sees the P&L. So if the preparer was only looking at the P&L and they weren't looking at the balance sheet, mistakes happen. So that's where you just want to make sure that that asset list makes sense and it includes everything that you've done. And then ultimately kind of looking at, that original page I showed of just, looking at your tax picture, wages all the way down, that can just help to see, am I in a good effective rate? How has it changed year over year? I mean, sometimes I go like 22, 23, 24, just so we can kind of look at how it's changed year over year. And then ultimately building out 24, before we get to the end of the year, just so we know that there's no surprises.
Mm-hmm. Hey, Kurt, that actually, one of the things Ann mentioned was the balance sheet. So is your tax preparer doing Schedule E for you that shows income expense? But are they also doing a balance sheet, keeping up with a balance sheet every year? Balance sheet's going to reflect like the asset itself, what you paid for it, but also like the loan, how much of a loan you took out. Because in your tax return, you're not showing them the loan balance. You're just showing them how much you paid in interest. The balance sheet's going to reflect the loan balance and the value of the property.
I don't remember seeing anything like that. So that's exactly what I need to know is what can I ask the balance sheet, something I wouldn't even know that. So.
And just to make sure, I mean, usually if you're using any sort of software, it has one there, but just to make sure that, the big thing, like Gary mentioned, is, loan balance, just make sure that interest makes sense for what they're showing. Again, the assets, that makes sense. Those are usually the two big misses.
Yeah, and then the other thing is the strategies, like my CPA or a tax preparer won't know kind of my goal necessarily and how to like handle the depreciation for the year or for long term or whatever. So
And that's where it's good to look before the end of the year, just to really make sure that like you're looking at any improvements that were done this year.
I want to meet with her, on Wednesday here so we can kind of plan a little bit, but
Yes,
that's the idea.
yes.
The other
Right.
thing too is the carryover of losses. Like usually, I mean, most people that I know that have real estate, including me, because of depreciation, it's easy to create a paper loss, and and you can only use so much of it. I guess it's limited to how much income you have. So you have some left over. So you should have some carry. Most cases, I'd be shocked if you didn't have any carryover, unless you have like no loan payments or something. I mean, maybe you're 100% cash and you have plenty of cash flow. But if you have loans and you have depreciation, you have just general maintenance repairs, you should have some paper losses because depreciation. Just think about that. If you had $1 million in properties, not your net worth or the net equity in your property, but the cost basis, let's say you paid $1 million for it, your depreciation on the one property is like almost like $35,000 a year. That's huge, you
Yeah.
know? And it doesn't take much these days to have $1 million in real estate. If you have 2 or 3 houses, you've probably got $1 million in real estate, you know?
Yeah.
So depreciation, I mean, heck, that's a major, it's like $3,000 a month just on that alone, you know? So it's all paper. I mean, it's a phantom or audio, but what do you call it, Ann? It's not a phantom write-off, but we call it a paper write-off, I guess. But
Yeah, just a non-cash deduction, but yes, same
yeah,
thing. So,
yeah,
but yeah, and that's where I think just you kind of knowing that also helps to kind of know the true cash flow versus, the tax return,
yeah.
and projecting forward is always important.
Curtis, is your tax preparer somebody you know? Is it like a friend or relative or something like that, or is it somebody you could? Okay, I mean, I would. Ann, I mean, can you serve people in multiple states?
Yeah,
Yeah,
that's my other question. Yeah.
Yes. Yes. No. And that's where I think, I've really spent a lot of time educating myself on real estate. As a preparer, I really like to understand the why of, the business side, not just the tax side, because I think it's important that every number tells a story. So I think it's really important to kind of dig into that. And I think, it's just important to build out a longer term plan of, what do you see happening next year? What happens in 2 years? Because the decisions you make to stay impact that. So I think if you can kind of look long term, and ultimately, that's where, a lot of our work is done quarterly. So that way, we're not as tied to like a crazy time of year and everyone's trying to hit the deadline and we just rush and then, things get missed or we don't have those conversations. So, whether it's with me or someone else, I think just taking the time to look longer term, it can really change the way that you view your tax picture.
yeah. Hey guys, just for the record, my tax preparer, he's not in the same town as me, not even in the same state. They don't have to be anymore. Years ago, that was probably the thing. You just use somebody locally, but anymore, you go with somebody who has the expertise that you need. Doesn't matter where they are, you know. So I've met my tax accountant, but I haven't seen him easily in 5 years. And probably the only reason I saw him was I happened to be there teaching, and I said, "Hey, you want to go to lunch?" So, I mean, and by the way, the reason I picked him, he used to own real estate. I thought, well, that gives me a kind of sense of confidence, and so keep that in mind. And by the way, and Kurt's in sunny tropical Minnesota.
Oh, yes. I love Minnesota. I was actually married in
Mhm.
Bemidji. So just like,
Oh, I went to college in Bemidji,
oh, really? I love Bemidji. So,
Bemidji State. Yeah.
yes.
Awesome.
Cool.
Hey, hey guys,
Yep.
any other questions? Anything you're
Contact
working on,
information.
or what's that?
Contact information would be great. I put that
Oh,
in.
Oh, yes.
yeah.
I just put my email. Anyone on this, please shoot me an email. But if not, I will get Gary the package of everything we went through today. Again, my goal is to get you all the information you need because my belief is best done by the investor with the CPA, but not, by the CPA. So I'm happy to send over everything I have. And if you have any questions, anything comes up, please reach out to me. I'm happy to help.
Okay. What we'll do is the email goes out tomorrow. And if you're here in class, that means you're registered. If anybody here did not register for class because you used somebody else's login, unfortunately, that person will get the email. But just ask them for it. And everybody listening in recording mode, obviously you're registered, you wouldn't get the recording, but we'll put it out there. It'll be on the website. Definitely reach out to Ann. I mean, I liked her as soon as I met her. I knew she knew what she was doing and understood the real estate business. But check it out. I mean, you could think of this way. You've got a team you're building, right? You got your lender, your tax accountant is a critical. Just listen to Robert Kiyosaki about this subject, right? Your tax preparer is a team member. You need somebody to play defense for you, and Ann is she's on the defensive side of the game. You need to play offense and defense. I'm telling you from personal experience. In the beginning, I only focused on offense. I was scoring so many points, I didn't even think about defense. Looking back at like 3 years, I realized, holy crap, all that money's gone. Unfortunately, we did some amended returns thanks to my tax accountant, Jerry. I know if you ask me about him, I'll tell you he's going to retire because he's in his 80s. His son was going to take over the business, and he decided not to, just like in the last year or two, and actually went to work for the IRS. so,
Oh, geez.
so I don't know what I'm going to do. Quite frankly, my life is much simpler now, thank goodness. But you need to have somebody like Ann on your side that definitely will pay for itself. I mean, it'll save you. You'd be amazed how much money you could save by having the right plan in place. You setting up the right structure so you have the benefits. You can determine when in the year you file and pay. There's a lot of strategic things you can do that are all 100% legal. It's in the code. It's in the code, and I don't have time to read it, but Ann does. So
Yes.
yeah. Any other final thoughts or questions, guys? Everybody looks like they're in food coma. So we've been doing a lot on taxes and lately. So the good news is, guys, we start the Vision VGAP in December. Vision Goals Action Plan. So get geared up for that one. And next Monday we have an attorney on. Okay. So I can't remember the last time we had an attorney on. So you want to be in on that one. He's in real estate, he owns a brokerage, and he invests. Okay. So just remember this, you have an attorney on it. This is you just like tonight, you want to invite your guests, okay? So they can get engage with somebody like an attorney for free. It's one of the great benefits of doing this. So, okay. Well, Ann, thank you so much. You mind giving Ann a pat on the back or a hand wave or
No, thank you so much. And please feel free to reach out if any questions come
Yeah.
up. I'm happy to help.
Thank you.
You got it,
Thank
Ann.
All right.
You're welcome. Well, guys, if there's no more questions, I'm going to go ahead and skedaddle here and
Thank
spend
you.
time with my, with
Thank
my
you very
uncle
much. Have a
and my
great day.
cousin. You too,
Thanks.
Ann.
Have a good night.
Yep. All right. Thanks, guys. Thanks for participating. I'll see you on the one-on-ones, and I'll see you next Monday, okay?
Bye-bye.
All right.
Take care.
All right. God bless you and all your loved ones, and I'll have you have an awesome night.
Thank you for watching this episode of Monday Night Live. Be sure to subscribe to our channel and go to realestatewithgarywilson.com to join our community and start building wealth today.